hedge fund.
The hedge fund.
A hedge fund.
Hedge funds.
They're the talk of the financial world, but are they running out of gas? The final and most important hour of the trading day is underway as we count you down to the closing bell.
When the big bell comes right back, debating the future of hedge funds. You're watching America's business news leader, CNBC.
Hedge funds, a hot topic, getting blamed for everything but bad traffic. And last night, Fed Chief Alan Greenspan warned that hedge funds could stumble.
You will see people leave the business because they do not have the critical mass and the resources to really run this money the way it needs to be run.
That was an exclusive interview yesterday with John Mack, the new chairman of Pequot Capital Management. We spoke about the future of the industry. Pequot Capital manages $6.5 billion. So, do hedge funds pose a risk to the financial markets? We turn now to two guests to talk about that. Richard Bové, senior financial analyst at Punk, Ziegel & Company, is worried about hedge funds and their extensive leverage. Charles Gradante, managing principal of Hennessee Hedge Fund Advisory Group, says hedge funds are good for the market. Gentlemen, nice to have you with us. Welcome.
Thank you. Nice to be here.
Charles, let me begin with you. Why don't you explain to our viewers really the structure of the business? We have so many different hedge funds / private equity firms that we talk about every day, whether it be Pequot Capital or Ripplewood Holdings or, so many others. And then when you look at large hedge funds, you've got a whole other group. Give me the structure of the business the way you see it. How do these firms work?
Well, hedge funds are limited partnerships that have a broad base of investment instruments that they could use. They can go long and short bonds and stocks. They can use derivatives, options, and futures.
Right. Now there are 8,000 hedge funds right now. Of course, apparently 40% of those funds have actually been created over the last 4 years or so. We're talking about nearly $1 trillion in assets. Clearly a major influence on the market, right?
Correct. I think they are a major influence, on the market, but I think there's a positive influence. Greenspan has come out, and other authorities have said that hedge funds provide liquidity in the marketplace, and they also help create an efficient market by spotting mispricings and bringing the mispricing into a more reasonable level.
Isn't that right, Richard Bové? I mean, we're talking about an enormous pool of capital providing real liquidity to this market. What are you worried about?
Well, I think the fact is that the enormous pool of capital is far bigger than you think. Start with the $1 trillion of investments that you just mentioned. Most hedge funds will leverage themselves 2 to 3 times, so that gets you up to about $3 trillion. Then they buy products which they call in the industry hidden leverage, and that leverage may be 10 to 15 times. Then you take a bunch of hedge funds, and a fund-to-funds company will come along and buy them, and that hedge fund may have 4 to 5 times in leverage. So when you wrap it all up, according to the Bank of International Settlements, there was something like 1.1 quadrillion. That's 1,000 trillions in derivatives traded last year. And basically, really nobody knows what's going on. Then you take the fact that if someone is leveraged, that means someone else is lending them money. So let's look at JP Morgan Bank. At the present time, they've extended, or they claim that their risk in this area is $66 billion. Well, that's 30% more than the tangible book value of JP Morgan Bank. So I would say that, we're dealing in a market in which nobody really knows what the product is. Nobody knows how much leverage is there. Nobody knows very much about the counterparties, and yet everybody is lending hundreds of billions of dollars into that market. So what we're suggesting is that you need a lot more transparency. You need to know a lot more information. There are hedge funds, for example, that will trade 5,000 times a day, which means that, someone calls into CNBC and says, what do you think of Citigroup? And you say, well, you might buy 100 shares. Well, he's trading against some computer which is doing 10-tick trades and will do 5,000 of them in a day. I think that the thing has become the Wild West. It's a little bit out of hand.
Charles, what's your comment on what Richard is saying?
I don't know where he's getting his numbers from. Our surveys of the industry indicate that 2/3 of the hedge fund industry are long-short equity managers that are limited to Reg T leverage, 2-to-1 leverage. So taking $1 trillion and multiplying it by 3 and levering it up further is a little bit of an exaggeration.
Yeah, and not only that, but I mean, isn't it a positive, Richard, to have a vehicle out there that you can invest in different things? I mean, it's just, there are so many alternatives today as far as money-making opportunities. It's just not only about domestic stocks. And isn't it a positive to have a vehicle out there that you could go short if you wanted to, and you could do arb trades, and you could go international real estate, all of the, or private equity, all of the different alternatives has to be a positive for investors.
Yeah, it certainly is. And by the way, the place that we got our figures is we did a poll of brokerage firms, and we asked them how much money they were lending to the industry. And then we asked them to go out and cut back to us and tell us, you know, how much leverage they thought was in the business. And these are the numbers that they've come back with. And the 1.1 quadrillion number comes from the Bank of International Settlement. But, you know, getting to your point, Maria, essentially, if all of this money was spread out equally over the markets, then it would provide liquidity. But that's not basically what happens. Take the convertible bond market, for example. Essentially, last year we did about $24 billion in convertible bond offerings in the beginning of the year versus $10 billion this year. Now, the reason is because the pricing, so much money was poured into convertible bonds that the pricing of convertible bonds got out of whack. We didn't add liquidity and create a rational pricing environment in the convertible bond market.
Right.
We created irrational pricing. Now, what was the result of that? Again, we issued fewer convertible bonds this year,
yeah,
which means companies raise less money, which means fewer people get jobs, et cetera, et cetera,
yeah,
et cetera.
and then you have the whole GM situation that was a whole nother bond issue. But let me go back to Charles for a moment, because Charles, Hennessee really tracks the industry, and you know where the money is going and how the asset classes have done. Tell me where the opportunities are right now. Where do you see a majority or most hedge fund managers looking to make money?
Well, there's a lot of money flowing into the international arena, especially merger arbitrage in Europe. Long-short equity had a very good month in May, and we think for the rest of the year that strategy will pick up. But I'd like to comment on the banking situation, which Richard is commenting on. And you know, Greenspan's speech pointed to the esoteric instruments that hedge funds are using in order to improve returns. I think if you read between the lines, he's also pointing at the banks who are creating these instruments for hedge funds, yeah, to make revenue, and are counterparties to those hedge funds, and therefore the risk is on their balance sheet. So, right, like long-term capital, it was much more of a banking problem than it was a hedge fund problem.
That's a good point. Real quick, let's hear it from Greenspan himself. Here's what he said last night at that conference to bankers in Beijing.
After its recent very rapid advance, the hedge fund industry could temporarily shrink, and many wealthy fund managers and investors could become less wealthy. But so long as banks and other lenders to these ventures are managing their credit risks effectively, this necessary adjustment should not pose a threat to financial stability.
Once again, measured on all counts, gentlemen, from Alan Greenspan.
Yes, and that's the lesson of long-term capital, Maria.
Good to talk to you both. Thanks so much. We appreciate it. Richard Beauvais of Punk, Ziegel & Company, and Charles Gradante of Hennessee Hedge Fund Advisory.
Thank you.